Welcome. My name is Gina Grandi, and I am the Dean of the Haskayne School of Business. I'm absolutely delighted to welcome you to the inaugural BMO Professorship in Sustainable and Transition Finance event. We gather here this morning on Treaty 7 territory and the home of the Métis of Alberta, Districts 5 and 6. Together, we move forward in a good way towards fulfilling our commitment to truth and reconciliation. This morning, we will hear from international experts on climate finance and the role it does and can play in energy transition and a prosperous economic future. We are joined today by some very special guests. We are joined by Dr. Nuno Fernandes, Jonathan Hackett, and our moderator and Haskayne's very own, Dr. Yrjo Koskinen. Thank you for your willingness to be here this morning and share your insights. I also would like to extend a special welcome to our Chancellor, John Cornish, who will be joining us a little later in the event. In 2021, a gift from BMO supported the University of Calgary to establish a new professorship in energy transition and finance. Through the BMO Professorship in Sustainable and Transition Finance at the Haskayne School of Business, Dr. Koskinen is delving into practical applications for oil and gas companies. Investors, policymakers, bankers, and investment managers as the global economy makes the transition to meet net zero carbon emissions. This professorship also supports his research on how environmental issues and carbon emissions affect corporate valuations and financing practices, research that wouldn't be possible without the support from BMO. Thank you, BMO, for your support and for recognizing how this collaboration between post-secondary institutions and the business community allows to build learning environments for future leaders, advance innovation, and engage with our community in critical ways. Following the panel discussion this morning, there will be time for your questions. And I don't know all of you in the room, but I know many of you, and I know you are going to have some difficult questions. So the panel, you need to be ready for them. I would now like to invite our moderator, Dr. Koskinen, to come forward to introduce our panel members, but also to call our panel members to the stage as well. Please enjoy the session this morning, and thank you for making time to be here with us.
Well, thank you, Gina Grandi, for the generous introduction. So we're delighted to have two excellent panelists. I didn't know that Ontario counts as a foreign country, but yeah, one from Europe and one from the great province of Ontario. So Professor Dr. Nuno Fernandes, he's a professor of finance at the IESE Business School in Barcelona, Spain, and managing partner in Odgers Berndtson Board Solutions, non-executive director at the European Investment Bank, and most importantly, author of a fairly new book called Climate Finance. That is also, it's not a typical textbook, it's more like written for practitioners, executives, and also, of course, for students. So before joining IESE, Nuno was the dean of Catholic Lisbon Business School. So you know that, so after you've been a dean, there's also intellectual life even after being a dean. So that's pretty good to see that. And a professor of finance at IMD in Lausanne, Switzerland. His particular interests are corporate finance, climate finance, mergers and acquisitions, corporate governance, banking, and financial strategies. So I guess the only one that's missing here is asset pricing. So pretty much you're covering everything else. And he's a frequent consultant and advisor to financial institutions and corporations around the world. And Jonathan Hackett is the co-head of BMO Energy Transition Group, head of BMO Sustainable Finance, and managing director at BMO Capital Markets. So Jonathan advises clients on opportunities in the transition to a low-carbon economy, supports clients on the impact of ESG on their access to capital, and advises on sustainable financial structures. So before joining BMO in 2017, Jonathan was a principal with the Boston Consulting Group and also a researcher in residence at the Perimeter Institute of Theoretical Physics, where he completed his doctoral research on quantum gravity and topology, which is of course extraordinary topical issues, especially these days. So I'm sure you made the right choice. You should have stayed with the quantum gravity. But we are very delighted to have the two experts, one giving perhaps more European perspective, and Jonathan giving more the Canadian banking perspective. So what are we having here? We're going to have roughly a 25-minute discussion, then open up the floor for audience questions. So let me start right away. And Nuno, maybe the first question is for you. What is climate finance? So how would you define climate finance, and how is it different from sustainable or responsible finance?
All right. First of all, thank you so much for the invitation to be here and to be part of this wonderful panel and the wonderful audience. I'm very glad, my first time in Calgary, and super glad to be here with you today. I think climate finance is part of sustainable finance, right? I think it's the more specific and measurable part of sustainable finance in general. As a finance professor, I usually say all finance is sustainable by definition, because if you really think about finance in a proper way, it's not about the quarterly earnings next month. It's about making sure companies survive in the long run and maximize long-term value. And so that requires to incorporate sustainability principles into the life of a company. Now, climate is a very specific part of that, and of course the weights of climate finance and the role vary a lot across companies. And I usually say, and that's why I wrote the book, and based on those principles, climate impacts finance and finance impacts climate. And so it's a two-way street. Climate changes, they impact finance because they create risks for corporations, risks for investors. And so that, of course, is a financial topic. But finance and the way we manage companies financially and investors manage their portfolios financially also has real changes, has real impact on climate change. And so it's a two-way street. And so it's very much interconnected. Maybe I'll stop here. I'll talk a little bit more about the alignment and transition and all these things later on.
So Jonathan, so what is your view on climate finance? And especially, let's say, talk about how it's different from transition finance. So part of my title says transition finance, and I always struggle to explain what is transition finance. So how is climate finance different from transition finance?
So I'll start with a caveat, right? Which is that sometimes it feels like my life is like a game of Boggle that's gone awry with different labels and saying, okay, does green include this? Does transition include that? And I've not found the standard setting body that truly does give definitive, mutually exclusive, collectively exhaustive names to all of these things. And so sometimes it's what makes sense within a given context. I personally think of, and usually the taxonomy that we have at the bank differentiates between transition finance specifically as driving a distinction between green or brown, and saying, look, if you've got a company that is undergoing a transition to a low carbon economy and is making the investments necessary to align with that, even if their fundamental actions are not something you would call green, transition can be something that describes material improvements and investments that align to that change. Climate finance I do think of as broader, right? Climate finance to me includes green finance, it includes transition finance. I guess it could exclude some of the green finance that's not aligned to a climate change outcome, that is just, hey, you did something nice for bees, which maybe connects, but maybe it doesn't. But it also can include things like mitigation and investments in resilience that don't fit neatly into a transition concept, right? So if I am building a better seawall, I am actually not doing anything to stop climate change from happening. I'm not reducing my carbon footprint. I'm in fact increasing my carbon footprint, putting a lot of concrete into the sea. But I might be materially reducing the impacts and the losses from increased severity of weather events. And that kind of investment is still aligned to what we as a society need to do in order to manage the transition to a low carbon economy, and also the reality that that transition is not going to occur on a time scale at which no changes occur. We're already outside of the realm of zero change. And then the question is the level of severity and the level of impact that you can have in different countries and different locations from those changes, and how do you invest in a way, or how do you make changes occur in a way that it drives that? And so to me, climate finance can really be an umbrella that includes a very large set of these categories.
And that's very true, that what you mentioned about adaptation, because we quite often talk about mitigation or reducing the impacts of climate change. But I mean, climate change is happening, and we have to adapt as well. Nuno, did you want to say something about transitional finance? You kind of alluded to that, or?
No, I mean, I think I'll leave it for later on. I think it's about, I think from a corporate point of view, and Jonathan, I think, gave a very good description from the BMO point of view. From a corporate point of view, I think there's definitely a clear understanding that the corporate investments have to be very well aligned with the transition to a low carbon economy, right? And so, but we'll talk more about this and the engagement with investors later on.
Yes. So, Jonathan, let me go back to you. And of course, very often, ESG, so environmental, social, and governance issues, are criticized that there's a mixed bag, and there's ESG investing, is there really any impact? Is it greenwashing, pinkwashing, whatever washing you have? Do we have same issues in climate finance? Does climate finance has any real impact in terms of mitigation or adaptation to climate change?
Yeah, so I'll distinguish, because I think this becomes very similar to the ESG question, one of the fundamental actions and then the labels. I think, are there impacts from things that I would call climate finance? Absolutely. If you build incremental clean energy, you're able to support a larger economy with a lower carbon footprint, and I don't think there's a question of, is there an impact on that? I think one of the questions is there an impact to creating a structure within the economy where we label these things? And there I would advocate that there is. I would say it's not easy to always draw a straight line, but we see in the interaction of our shareholders with our bank an increased demand of us being clear on how much we're investing in this. And part of that you might say is, oh, it's just virtue signaling, or it's people saying, I want to know that my bank is doing things that are aligned to my interests. But some is actually, if you take it from a rigorous risk approach, saying, how are you investing on this area that we believe generally is going to be a large investment area? Are you doing things that are setting you up for success in a large revenue opportunity going forward? And how do I understand the contribution to your mix? I think the other place that I've seen it directly is with corporates, where we, years ago now, undertook a journey to say, we think nuclear is green. Not just, I think nuclear is good. Like, I'm very biased. I'm a theoretical physicist that does sustainable finance. It's hard to not end up in a place where you're pro-nuclear. Not everyone is in that spout, but for me it was very easy, especially in Ontario. But there was a gap in the market where essentially people weren't clear. Yeah. That if you looked at the Climate Bonds Initiative, they would say nuclear is aligned to a 1.5 degree scenario. And they would say, we're going to get to it someday, but never define the date at which they would actually adjudicate whether or not nuclear is green. And many other organizations took the same approach. The European taxonomy debate was raging, and still feels like it's not 100% settled, even if nuclear is green under that. And so we worked to do the first nuclear green bond. And we've seen the trajectory of nuclear acceptance over the last few years, and obviously Russian invasions have done more probably to drive that acceptance than just us focusing on that green label. But we see the reaction from investors and seen the reaction from governments of that actually making a difference, that there is a clear label that this is not just transitional, this is not just the best among bad options, but it is a real solution that drives the transition to a low carbon economy. And that green label has really helped, I believe, the nuclear renaissance that we see now. That people really do look and say, okay, how do I understand how my investments as an individual, as an investor, are going to align with these global national governance frameworks that say what is aligned to the future, and am I going to be at risk of some large policy outcome coming down and hitting me like a bolt from the sky? I think hydrogen still has this problem where, call it blue hydrogen or hydrogen with carbon capture, is something that a lot of people will point to and say, that's transitional. Others will say, like if you take Bill Gates' position, that's not transitional, that's a solution. That fundamentally is something that we can do that solves some of our challenges. But the problem is, if you're an investor, This is a policy-driven transition. It is not simple market forces in absence of government, because that's what we've had for the last 100 years. It is driven by policy, and whether or not hydrogen is aligned to those national policies makes a massive difference. If the IRA, hydrogen being there is $4 a kilo on an economics of $4 a kilo. Like, that's a massive difference from it being part of a taxonomy. And so I think that it can really drive reality when you say something is green or not green in this context.
So I mean, I'm happy to hear that from an actual banker and practitioner that you think that climate finance has a real impact, because there's a big debate now in academic finance, not necessarily about climate finance, but ESG finance in general, that the impact is marginal, it's very, very small, we can hardly detect this, and yet the market participants seem to be more sure that there is a real impact. So Nuno, what's your view? Does climate finance, does it have real impact? Or is it just a few basis points that have a marginal impact? Or does it really make a big difference?
Well, I think I'm most likely biased in my answer, since I wrote a book called Climate Finance, right? So let me a small caveat to start, and I'm going to answer both as an academic and as a writer, and what I saw is, because the book is basically a collection of research from more than 400 references and sources and authors, including Professor Koskinen, of people that did fantastic research on this topic, and there are indeed results. So it's pretty obvious. There is strong evidence that it has an impact on companies. And I can also bring you the practitioner side, because as Professor Koskinen mentioned, I'm a member of the board of the European Investment Bank, which is the EU climate bank. So it's the biggest bank, the biggest development bank in the world, 3 times larger than the World Bank in terms of assets under management. And one of the roles is to focus on the transition and be the EU climate bank. But then how do you do that? You have to go beyond labels and all these things to granular metrics. And so we developed internally a model for assessing risk, and this is just to show you how these things have to be very concrete ultimately. A model to understand risk at the corporate and project level that depends on physical risks, incorporating physical risks, transition risks, opportunities as well, into cash flows, into drivers of investment, into things that ultimately we can factor in the business case. And there's for sure an impact. There's strong evidence of that. I can also tell you from many of the companies I work with that just very recently a CFO of one of the largest utility companies in Europe said exactly the same thing. I mean, they say, I go to my capital markets day and the investors are asking me. So they're asking me, they want to see real transition happening in the company, and they're asking me, demanding me for that. So I'm sure it's real, right? From all the sources we're observing, it's real. At the same time, we are living through a change process itself, right? This is a personal transition and change process for all of us. I mean, these things are new. These things happen in the last 5, 10 years, if you want, and that's it. And we're living through it. We've lived with loans and bonds. I mean, bonds were invented in the 17th century or 18th century. Loans millenniums ago. And so we lived with financial instruments for many, many years, and we're very used to that. And now we have this thing, which is a transition, a climate change and climate finance coming along, which is a big change process for us personally. And we're living through the change process. And change, I mean, somebody here in this room that says they love change, I don't really understand, right? I mean, no one likes change personally as an individual. We like to do things the way I mean, we don't like to be confronted and say you should change here. And that's normal. And now we're changing, and in this change process, there are pains. And the pains, we're living through these pains. The pains are the taxonomies. There are no clear definitions of what's green, what's not green, disclosure, and all these things. We're living through them, and it's very painful to live through change and in this process. But it's a needed change, and so we have to go through it, and it will be able to do and live through it. Because what we also know is that there are very big investments that are needed to transition to something that we need. We have to transition to a low carbon economy. And the huge levels of investments that are needed, it's pretty obvious that it's not going to be the public sector or governments that are going to do it on their own. So then it becomes a private investment issue, a private sector issue, and it's about risk and return and normal finance topics. And I see more and more demand as well from the corporate side. As an educator, I do more and more company-specific courses on ESG investing, what it means for a company to properly live and do ESG investment in their capex, in their M&A process, in everything. Not just have a very fancy chief sustainability officer and have a sustainability department. All companies do that, but if you really want to be sustainable in the long run, you have to live through that through all your operations, and so to different managers. So I definitely see interest and impact from all the different sides I observe.
And that's also some a European perspective, because Europe is this kind of, I would say, ahead of North America in terms of climate finance and awareness of climate change, because the temperatures in Europe are going up twice the rate of the global average, and then our geopolitics are very, very different than North America. And if you read, let's say, Financial Times, which is really the mainstream newspaper in Europe and of course globally, it's full of climate change stories and climate finance stories. So it's really, I mean, very, very big issue in Europe.
It is, but at the same time, being in Europe, often I hear people saying that the US is more advanced and North America is getting much more advanced, including with the IRA and all that. So, I mean, I think you always look at the neighbor as being more developed than you. And I think, and factually speaking, data, when I look at data I have in my book in many different dimensions, the US is more advanced and has done much more in some areas of climate finance. And if I look at the 85 case studies I have in the book, maybe 30 of them are from the US. So I think you have good practices everywhere, but there's also a political backlash that we know is very prominent this year in the US.
So there's a saying that never bet against the United States, and that's probably true. The US is, the business of the United States is business, and then they'll figure out things in the end. Jonathan, let me ask you, thinking in terms of financial instrument, from the BMO's perspective, if you're financing climate change projects or adaptation or mitigation projects or transition projects, what are the most important financing instruments that your bank is using?
So I go back to the starting point in these conversations often is just a statement of like green finance or transition finance. Like the key word first is finance. The number of times I get an email that says, hey, I have a green project, somebody's told me I can do a green bond because of that, like, can we do this? And the starting question is like, well, can you do a bond? Because if you can't do a bond, we're not doing a green bond. There's no magic pot of money that exists that allows us to go and do unfinanceable things because they're green. And that is the reality we live in. I think, to me, the things that are driving that change the most are loans, bonds, and equity raising. And there's a skew where, we probably do more private capital raises in energy transition than we do in any other group by proportion, and that's because there are more companies operating at an earlier stage that need riskier capital in order to get them to the next stage. I think there's also a kind of a barbell where we'll do a lot more bonds than we'll do bilateral loans in that same space, because so many of these things are large-scale projects that when you've got those pieces right, they lend themselves to structured finance. They lend themselves to contracted cash flows, being able to take the risks away from the individual company and really saying, no, this is about if this plant operates, if this facility delivers what it's supposed to do, then we will get a set amount of cash, and therefore we can put a lot of leverage on it and do that in the public markets. And so there's some weird skews, but at the end of the day, what we're really trying to solve for, and this is one of the few places that being a recovering physicist mathematician helps, is there's this like old story of a math professor like putting out a fire in a garbage can and then like essentially solving the problem by making it look like the last time you put it out and not actually putting it out. Because that's what mathematicians do. They make something look like a solved problem and they're like, yeah, this is all done now. And a lot of what we're trying to do is the exact same, is saying, look, if I can make something look like solar because it has a power purchase agreement or a carbon purchase agreement that's structured like a power purchase agreement, there is the greatest piece of technology in the energy transition is not solar, wind, nuclear, carbon capture, anything else. It's actually structured finance under power purchase agreements. That is the most powerful thing that humanity has created in the last 30 years to drive the energy transition. And the more I can make anything look like that, the more capital that can show up suddenly. And so a lot of what we're trying to do is say, how do we make things look like other problems that have been solved in the past?
That's music to my ears as a finance professor. Structured finance is the most important thing. It reminds me of Albert Einstein, who said that the compound interest is the most formidable force in the universe.
I think that was actually Ben Franklin, but
Was it? Well, it's a good quotation,
Yeah.
right? So, Nuno, from your perspective, so Jonathan was talking a lot about primary markets, so raising capital for new investments. What would you say about secondary markets, so trading equities, bonds? What would be the most important aspects in climate finance in, let's say, in secondary markets?
Okay, to start, I definitely agree with Jonathan that, I would say the debt side of the balance sheet is much more developed in terms of new financial instruments and new finance sources than the equity side. I mean, the equity side is shares, and no one has invented new. I mean, maybe have dual class of shares, voting, non-vote, but that's about it. So shares are shares. On the lending side and on the debt side, there are lots of developments. I mean, can be structured finance loans, can be green bonds, can be sustainable linked bonds, sustainable linked loans, I mean supply chain financing, sustainable. So there are lots of new developments there that corporates are using, not just for primary investments. I'll give you an example. Sustainable linked loan for AB InBev, the largest brewery in the world. $10 billion loan, which basically is for working capital purposes. I mean, it's for normal working capital purposes. What's interesting is that they have committed in that loan, why it's called an SLL, Sustainable Linked Loan, is that they have given 5 KPIs, and those 5 KPIs, if they achieve those KPIs, the interest rate goes down. And if they don't achieve those KPIs, which are related to water usage and emissions and things that are relevant from a brewer point of view in terms of their footprint, if they don't achieve them, the rate will go up. Now, think about that. I mean, if you have something, an instrument which is a $10 billion instrument like that, which lasts for 5 years, and you have committed to paying these things, the cascading this throughout the organization is going to be done for sure. I mean, it's going to be very well cascaded throughout the organization, the water usage and all that, much easier than if you had not had a financial instrument behind. So I think finance also brings incentives and allows, it's a way to speak the same language and align incentives inside companies. On the equity side and on the secondary market you ask, I mean, I think here, climate finance, the importance for investors is definitely on the rise. And so analysts, all kinds of investors, all kinds of equity deals now take this into consideration, from private equity deals to public equity deals. M&As, IPOs, SEOs, they all take this into consideration, not for ideological reasons, but for simple, if I'm a private equity firm, I may like it or not, but I know for sure that 5 years from now, my exit value from my position is going to depend on the carbon footprint of my investment or the sustainability of my investment. So, of course, ex ante, I'm going to factor that into my business case. And in listed companies, through the secondary markets, through the investors, you also see important changes happening at the governance level. So board of directors are getting much more involved into these topics. Chairman of a large electricity company, he was telling me the other day, I mean, when I meet investors, even passive investors, they challenge me on these topics, right? So they not just the normal things they would challenge a chairman, which is on financial performance, on separation, CEO, chairman, independence on the board and all that. They challenge me on really evolution on our sustainability footprint, even passive investors. But I think the issues vary by company, and we cannot take a one-size-fits-all. I mean, sustainability, climate is not going to be so relevant for a pharmaceutical company. A pharmaceutical company, it doesn't have that much of a climate footprint. Still, investors are demanding much more that a pharmaceutical company thinks much more about, in this case, social issues, or can be pricing of drugs in emerging markets, can be other issues. So I think from all the dimensions, investors are becoming much more vocal and are passing that through the chairmen and the boards of directors, and that is through the users of financial instruments is also being cascaded throughout the real economy.
Yeah, that's true. And of course, for businesses, incentives matter. And if you have cheaper finance, better access, if you exceed compensation in tied to certain KPIs, yeah, behavior is going to change. I mean, talk is cheap, but when you have money on the line, then people start behaving. Let me open it up for, I have a whole list of prepared questions, but I mean, there's an expert audience here. I would like to open up this questions for the audience. So if you have any questions, And we have a mic. Oh, yeah, there's a.
Yeah, fascinating topic. I'm interested in the sustainability linked loan. Was that 10 billion creating the KPIs associated with better governance demanded by the lending institution, or was this dreamed up by the company that wanted to access the capital? So are we seeing a shift in lenders that are demanding sustainability links, or was this just a novel use?
I mean, I cannot tell you exactly the origin of that. I can tell you it was pretty much, so who had the, it's like a chicken and the egg kind of problem. But here, I can tell you it was very mutual, right? From the corporate point of view, from AB InBev point of view, the 5 indicators were related to their internal assessment of what are the most critical items. And the brewer, for sure, water consumption is very important. So they identified what are the most material items where they have a sustainability footprint worldwide. And then they go to lending institutions and the investors and they say, of course, we care about that, because if you don't take care of your water consumption, this is just one of the 5, right? But the water is very visual, and so I just talk about water, but there were 5. If you don't take care of your water consumption, you are going to be a very bad company in 10 years from now, because we know water scarcity is a problem. We know, so you're going to be a very risky company. If you're a very risky company, we're going to charge you more, either as an equity investor or as a bond investor. So why don't we align these things and make sure you use less water, and if you do that, we charge you less, not because we love to save water, but because we love lower risk investments. And so if you're lower risk, we charge you a lower rate. And I think it's very, again, alignment through finance and not through philosophy.
I can add, like, look, in the Canadian market, SLLs are not driven by banks demanding them of their clients. They are fundamentally a tool for us to support our clients on their sustainability journey, to show our willingness to align ourselves to those outcomes, and kind of the, like, strapping yourself to the mast together of saying, like, we're in this together. Can I see a world where you could have real sustainability outcomes baked in? Yes, I think that's much more what we're seeing in SLBs and the sustainability bond world, where, you know, if you tell me that you're a, you know, Southeast Asian power company and you're going to be off coal by 2040, and I'm going to give you debt that has to be refinanced in 2045, it matters to me whether or not you actually have gotten off coal. It really matters to me, because my fundamental belief is that, look, like, the issue is not, will somebody want to do the debt now? Like, most markets are open to most people. The question is, if I am giving you debt that has to be refinanced at some point, what does that world look like, and are you going to have access to capital? And for me, coal is an example where as you get closer to 2050, like, you have to ask, is there debt available for this? And what does that debt look like? And is it enough that I get paid out? And so creating incentives that say, by the way, if you don't get there, I want you to start paying me now, because you're going to have to pay someone, and I want to make sure I'm getting something out of it along the way. That makes sense, but we're not at the point of what I would call, you know, I can say there's materiality in that if you take 5 bips times $10 billion times 5 years, that matters. Like, it's enough to get a project done that wouldn't get done. It's enough to get somebody to care. It's not the same as a real ratchet that says, by the way, if you fail to hit your goals, I think that's like a credit rating drop that is going to, I want to bake in and really hit you with, because even if it doesn't happen, I think that's the fundamental price that you should get charged at, because the risk I'm taking on as a bondholder.
Can I add just one thing? I mean, because from the European point of view, I see the banks are pretty much, I mean, so they are starting to realize, so it used to be much more demand-driven, corporates, but now banks, forced as well by regulation, because the European level regulation it says that banks have to report green share of their portfolio and have to have green metrics and have to report those to investors. And so guess what? If an investor needs to report that, they start asking their clients for that. And so banks are being much more proactive in doing that. And through that, they're also cascading that throughout the economy, because now, I mean, we know that ESG criteria are going to be part of the credit assessment process in all commercial banks in Europe 2 years from now, right? And so but not just for large listed companies, for SMEs above, I don't know, 50 million, 100 million of revenue. So it's going to be definitely at the corporate level demanded by any kind of financial institution that companies start thinking about these items. And so it's an unavoidable truth.
So the first question, the excellent questions from Rod Hurd, and Rod is an investment manager and formerly with Smart Beta. So if I could ask you if you could introduce yourself, so the benefit for our speakers, you know where your question is coming from. So is there any additional more questions? I'm sure there are.
Hi there. Hard was Bonnie, master's student at the UFC. So for, I guess, BMO, I know as a bank, they're on, I guess, path to invest almost 300 billion by 2025 in terms of financing for renewables and sustainability. Where do you think we are to reach that goal? And then just for the panel, carbon markets. So in our programs, this is something that's come up a bit, but not enough, I feel. And where do you think that is right now, and where is that going as well? Thank you.
Yeah, so I'm obviously not going to say exactly our 2023 results, just because we're in a very specific time on that. If you, though, look at that number, so that specific number here is the commitment we made. Initially, we made a different commitment that included our global asset management division, particularly in Europe, that was doing asset advisory. That actual goal got exceeded prior to our selling that team, and we reset our goal as $300 billion of capital mobilized to support our clients in driving sustainable finance, essentially starting in 2019 with a goal by 2025. If you look at the hockey stick in that space, as we actually originated the sustainability-linked loan market in Canada, as we've driven a large degree of sustainable bonds, that number, like if we kept our momentum from last year, if that is a thing that we did, we would greatly exceed this year, our 2025 goal. And so one of the fundamental questions we have to answer for ourselves as a bank is, do you just keep on setting bigger and bigger goals, or do we have to get more granular? And so that's, I think, really the question that we have to grapple with is, what felt like a big, ambitious, how do I know I'm going to achieve this goal 5 years ago is now table stakes. You know, every bank has one of these goals. Everyone has gone through some level of resetting at some point. And now we have to ask, what are we fundamentally driving when we do that? And are there things that we want to push on more specifically? To me, the carbon markets is a great example of that. You know, we acquired a year ago a company called Radical, a Calgary-based carbon advisory firm. That's 100 people that we added focused on the carbon markets across the enterprise, between carbon footprinting, carbon credit development, carbon protocol development, carbon marketing, carbon trading. That has not felt awesome when you've gone through what the voluntary market has gone through in the last 2 years, where we've seen criticism, concerns around specific methodologies. But it feels amazing when you look at the full set of opportunities in the carbon market, when you look at carbon removal technologies, when you look at technologies like BECCS, biomass energy with carbon capture and storage, when you look at the prices that are being paid by not just ourselves, but other organizations as well for direct air capture and carbon removal technologies, having 100 people working in that space feels like, in some ways, I love to think that we're ambitious and geniuses, but it also makes me look at every other organization that operates in this space and saying, how do you not have 100 people? How do you not have, when we talk about fundamentally a new part of the economy, a new market that is about creating benefits associated with doing good things and connecting them together and helping create the incentives that are going to drive market forces in this space? How do you not have dedicated people that do nothing else than work on this is to me shocking. Or, how is it 3 people and not 100? And so I think, yes, absolutely there's scrutiny. Absolutely there is a desire for quality. And if we're going to make this a $1 trillion market, not a $300 million market, you need to have those things. And there will be winners and losers in that process. But fundamentally, for an organization that is about giving our clients the best advice possible, to drive the transition to a low carbon economy, it is table stakes for us to have a scaled team working on how do we do that. Because like I have an adage that I keep going back to, which is nobody pays you to do a good thing in this world. People will pay you to measure and prove and demonstrate and use a credible methodology to show that you did a good thing in the world. But if you took like 100 million tons of certain chemicals, poured them in the ocean, you would probably do more for climate change than any other action. You just wouldn't be able to measure it. And so that's a government solution, not a corporate solution. But doing things that we can measure, show, and demonstrate the impact of is a corporate solution that we can help people navigate in that space.
Yeah, and if you have measurable solutions to reducing CO2 emissions, and the whole idea of carbon credit markets is that then you can sell that to somebody else, and that's an incentive for you to do more and more investments. What is your view on, let's say, carbon credit markets? There's a lot of criticism about this. There's credibility issues, and we don't really know. I mean, if you're buying some carbon credits and say somebody is doing reforestation project, does it really reduce CO2 emissions? And so there's a lot of criticism. They say, oh, this is a kind of permissions to pollute for other companies.
I think that's true. And I mean, when we buy an airline ticket, it says, do you want to do the carbon offset of that? And then who knows where that money is going? Is it going to? But I think that's small, right? I don't think that's. I mean, I think those are things to deviate the attention from the most crucial items. To be honest, I think the most crucial item is that we know that carbon markets would be the ideal solution, and we would have. What's the problem is that we have, if I'm not mistaken, 58 carbon markets around the world, right? And here, even in Canada, if I look at Canada, there is a national carbon market, there is an Alberta carbon market, there is a carbon market in Nova Scotia, one in Quebec, and I'm sure there are more than that, right? And if I see what's the carbon market that exists here, the tier, the Alberta carbon market, the front page says the following: TIER is a unique solution that allows the province to reduce emissions without interference from Ottawa. Okay, so I think that explains. I mean, I don't want to go into.
Albertan already.
I mean, look, it's this same thing happens in Portugal, right? I mean, I'm from Portugal originally. There is a Portuguese telecom regulator that tries to do everything they can to deviate from the European rules, right? Because they say we are different from the Europe. And so the problem is that you have fragmentation of regulations and markets around the world. And so, I mean, ultimately, 1 ton of CO2 emitted in Alberta has the same impact on the world as a ton of CO2 emitted in Portugal. But we don't have a global carbon market. I have lost expectations that carbon markets would save us. I mean, I hope I'm wrong, but I've lost a bit those expectations. And I think it's through the investors and through capital markets that we're really going to get there, because capital markets, yes, they're global. I mean, BlackRock or Vanguard or Fidelity, they invest globally. Please don't tell them not to invest globally. They will invest globally, and they will share risk globally. Now, any kind of thing that depends on regional governments, national governments, I'm much more skeptical on that. And I think it's through the power of finance, investors, and companies that want to align with investors, I think that's where we're going to have real change.
Thank you. Any more questions from the floor?
Thank you so much for really good insights you've provided. I'm a PhD candidate at Haskayne School of Business, and my question is about one of the main issues you have addressed in the first chapter of the book. In order to transition to a low-carbon economy, we need a global battle against the climate change and a global collaboration. However, what we have observed, the trend we have observed in the past decade is that these developed countries are trying to transition from carbon-intensive business plan to carbon-neutral business plan. However, in the developing country, where the maximizing the profit is the main goal of either the government, the corporates, and the other players involved in the ecosystem, we have observed a rising trend in the level of carbon emission and the other indexes. So I want to ask about your assessment about this. As we go through, this developed country are trying to curb emission, reduce the carbon emission. However, this developing country are trying to increase the emission. And as this developed country are reducing their emission, the demand would decline, and also the energy, the fossil fuel, for example, would be cheaper, and it's highly likely that these developing countries moving toward business plans that are carbon intensive, dependent on fossil fuel a lot. And this actually caused the battle against climate change and the transition to face difficulties and even fail. So what is your assessment, and what would be a potential policy to address this and to actually prevent this from happening, and have at least in the future, a successful transition to a low carbon economy? Thank you.
Thank you, Mohamed Hossein. So the question is about the differences between us as the West and what we call global South, or we used to call developing countries. Who wants to go first?
Go ahead.
I think, thank you, it's a great question, and it's, of course, the global geopolitics of this topic are huge, right? And I think that's why I start the book actually with that, as you noticed, but I end also with that as well, because I think global geopolitical issues are super important, and we need to think about the political economy implications of many of the decisions that are being taken worldwide. And the concept of just transition, for instance, is an important concept, because if you think about a country in Europe like Poland, where most of the economic activity is coal mining, and you say you can no longer mine coal because coal is dirty. Okay, that's great from a CO2 perspective, but what do you do with 20 million unemployed people, right? And so there are social items, so you have to balance this. Now, beyond that, and going to your developing versus emerging market, developing versus developed world, I think we are sometimes, and again, I think that's where we need to be very careful and look at real data and not fall into what the media tells us, because I think this conversation is super fashionable in Europe to say we are green in Europe and China is polluting, right? That's kind of China is polluting. So we're doing, even my kids at home, they tell me that. Why should I recycle? Why should we do this when the Chinese, they're polluting so much, right? So this is what the media tells us around the world. And I say Chinese could be any kind of developing country. Well, that's very fashionable and it's very nice for PR, but the reality is, we look at the numbers, right? And the numbers are very easy to see. Who is polluting more nowadays? Yeah, of course, China. But when you look at on a per capita, it's no longer China, right? Because if China pollutes more, because China has 130 times more people than Portugal. So of course they pollute more than Portugal, right? So is that a fair comparison? Obviously not. So you have to look on a per capita point of view. Still, China, and when I say China, I mean all the developing world, 50% of the energy comes from coal. Okay, so that's true. So much more polluting in general the developing world than the developed world. True, that's true. That's a fact. That's a picture taken as of 2023. It says the developing world is polluting more than the developed world. It's a fact. Now the important thing is to look at the stock. Right? And no one looks at the stock very often. And when you look at the stock, the numbers are staggering, right? If you look at the cumulated CO2 emissions that are out there, and those are the cause of global warming and all the bad stuff we know, who polluted the world was us, the developed world, right? Was Europe, the US, not China, not India, not Bangladesh, nothing, right? All the pollution out there was created by the West. And now the West stopped polluting and asks the East or okay, you cannot pollute because we were. Now, this is tricky, right? So you see, it's much more complex, and it would be a discussion for hours, but it's much more complex than a picture taken at the end of 2022 saying, country A pollutes more than country B, country A is bad, country B is good, right? It's much more complex than that, and you have to take into account stock, and you have to take into account political, economic issues.
Jonathan, what's your...
Yeah, I'll go to a different kind of stock and flow, because I think part of this is, at some point, the marginal opportunity will shift, right? The issue right now is that we still do not have solutions to say, don't build another coal plant. Because yes, not building a coal plant is a lot easier than retiring a coal plant that exists and is part of the grid. And if we can create the right incentives to build the right kind of power for the next incremental, whether that be, even today, LNG is a great solution in certain places. Having things that are more easily abatable would be a solution. Small modular reactors and large-scale nuclear, even in different places, are all valid solutions. The issue is, how do we buy down that difference so that a business case that's made today doesn't overwhelm the fact that this is now just going to be a part of the big problem that we have to solve later. we can have a debate about global carbon markets and the right way to do this. Article 6 of the Paris Climate Accord that unfortunately did not get fleshed out last week as much as we would have liked it to, is a potential solution to literally say, look, you have nationally defined contributions and targets that you're going to achieve. Developing countries have their nationally defined contributions that they're planning to achieve. And there are times where a small investment, and you think about the marginal cost of abatement in a developed country, when you've done all the low-hanging fruit, it goes higher and higher. And that simply not building or changing the trajectory in a developing country can just be a lot cheaper. And it gets tarred with a really negative framing, right? There's the like, oh, you buy cheap carbon credits from, these other countries, and that's allowing polluters to, continue pollute in developed countries and not do the work. But the reality is if we can stop someone from building a coal plant by just paying them not to, and help making that difference between the marginal power production cheaper, and if that costs $8 a ton of carbon avoided, and that country recognizes that they're going to actually say, oh, great, we decarbonize faster, and transfer those carbon benefits to the country that's paying for it, that is just reducing the friction in the economics that exists, right? Like painting people as making a bad choice because they are buying carbon removal at a cheaper price in a different part of the world when we all breathe the same air, when our environment is all influenced by the same carbon concentration, is, I don't even know the type of nonsense to really label it as, but it is nonsense. It is an economic friction that we create because we're distrustful of other countries, because we are distrustful of people's motivations. And I think we have a really large problem that can't allow people to just invent frictions and create frictions. We need to remove as many frictions as possible to get the trillions of dollars of capital to the right places that need to be invested over the next 30 years.
So I think we have time for a brief question and then brief answers, and then we have to close the event. If there's one more, please, and let's make it now very brief and brief answers, and then we can close the event.
I'm going to make this question very brief. It's very much related to the COP28. So on Monday, the draft deal said we are going to reduce the consumption and the production of fossil fuel. And then on Tuesday, the final deal said we are going to transition away from fossil fuel in the mid-decade, quite likely 2030. So from the financing perspective, what do you feel this nuance of the word between Monday's reduce and Tuesday's transition away implication on the future of the fossil fuel investment? So does it mean we are going to considerably reducing your investment on fossil fuel by 2030, or it's just a nuance, just let things go as what is supposed to be? No difference. Thank you.
So it's the COP28 question, good, and then brief answers. And
yeah, the short answer is I fundamentally don't believe there's any solution that will reduce fossil fuel financing or influence fossil fuel financing that is not a result of reduced demand. And that requires solutions, right? Like when we say transition away from, there has to be a two that is able to credibly demonstrate an ability to provide the energy that people need in order to not die and to have economic growth in the developing world. And until we have those pieces getting put in place, I can say I want to lose weight, and if I'm not willing to change my diet or exercise or change anything about my lifestyle, I can make all the declarations I want. Those pieces are necessary for that to happen. I don't think anybody's going to reduce reliance on fossil fuels without investing in a whole bunch of solutions that allow people to have a lifestyle that we've become accustomed to in order to drive demand reduction.
so, final word to you.
Final word to me. So I totally agree with this. I'm not going to dispute that. I think that the demand and supply have to be linked, and that the supply doesn't go away while there is demand. I think that's crucial. Nothing. I mean, I think it was great to be here. Just please be in touch if you want. We have my contacts on the announcement for this page. I think it's a very excited to share and spread the message on this topic and go deeper with any of you and get to learn any cases you have or any challenges you have. enough. It was a great opportunity for me to be here with this fantastic audience in a place that I know that cares deeply about this transition that we're on, which I say again, it's a change process, and all change processes are difficult, right? And we have to live through those, but we're going to pass it. And I think this wording on the COP28 is just an indication that the alignment broadly is getting there, right? And we are getting stronger and stronger alignment. But we're going to get there, right? One more year, one less year, but it's there, and it has real impacts. And but we have a change process to live through, and sometimes that's personally challenging. Okay, but the best of luck with that. I have all my support.
So I call in Jessica Berger, the director of Haskayne Centers, to close the event.
Super. Thanks so much, Yrjo, Jonathan, and Nuno for a really engaging and topical discussion this morning. So if you please join me in a round of applause for our speakers. Before we wrap up, I would also like to thank BMO once again for their generous gift towards the BMO Professorship in Sustainable and Transition Finance. BMO also supports the mentorship program at the Haskayne School, and we're deeply grateful for your investment. I'd like to thank Lasha, Mujan, Theo, Colleen, and Omar, and the rest of the Haskayne team for putting on this event this morning and for their support of this program. The West End Catering and Encore AV staff, and our Haskayne student volunteers who helped everything run smoothly today. I also want to thank our students from the University of Calgary and actually a student from the University of Alberta for joining us here this morning. If you enjoyed this event, I wanted to let you know that the Center for Corporate Sustainability and the Haskayne School of Business have another event coming up on Thursday, February the 1st, and that is the Petronas International Energy Speaker Series. This edition of the event will feature a conversation with Carlos Pascual, Senior Vice President, Geopolitics and International Affairs with S&P Global, and Jackie Forrest, the Executive Director of the ARC Energy Research Institute. And over this session, Carlos and Jackie will discuss the often contradictory predictions of long-term local and global energy demands and the opportunities and challenges that will arise with the evolution of global energy systems to combat climate change by 2050. We're thrilled to have Petronas' support of this initiative. We're very happy to have representatives from Petronas here today, so thank you for your support. Once again, thanks everyone for joining us today, and on behalf of the Haskayne School of Business, we wish you all the best for the holiday season and into the new year. Thanks.